Okay, hello everyone. Good evening. Looks like most everyone has joined in, so we're going to go ahead and get started. Thank you for joining us for this New Capital webinar, Fixed Income Bonds in a COVID World. This is Catherine Barr, Director of Communications at New Capital. As usual, we will have the Q&A session at the end of this presentation, so please feel free to submit any questions you have into the Q&A tool at the webinar, in the webinar menu. It should be at the bottom of your screen. And before we get started, I'm going to make the following regulatory disclosures. Sorry, this New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you.
Welcome, everybody, and it's nice to have you and to be with you. I hope you are all doing well. Okay. This right here is Abby Golub, my daughter. I'm very proud of her. She and her friend were earlier today making a demonstration on one of the bridges over 59. She was very bothered and upset by the killing of George Floyd in Minneapolis, as was her friend, and the two of them decided that they were going to take some steps, make a demonstration, and so they went. And people protest on these bridges fairly regularly, and they decided to go ahead and do this. So very proud of her. And so I asked her, did they get any honks? And she said it was really nonstop honking in support of their sign. So I want to dedicate tonight's webinar to Abby and all the young people of the world who understand, I think, that we have to change bad habits that have developed and are longstanding in the country. We're going to talk tonight about, I'm going to talk tonight about bonds. This is a really tough area. I think most people know bonds yield very little. They had already yielded very little before the crisis, and now they yield less. But before we get to that, I want to show a little video. This is from David Booth. David is the founder and chairman of Dimensional. There are a number of legends in the investment world, and David is one of those. Truly a giant. He's not as well known as John Bogle, who was the founder of Vanguard, or Warren Buffett, but he truly is a legend in the business of investment. And he's still the CEO of Dimensional. Of course, many of us have quite a bit of money invested with Dimensional. And I thought he put this out. It's really nice. So I'm going to play this. It's pretty short, but I thought it was something I would share with you also. Let me see if I can get this thing going here. All right, it's going to go over to the other website, to our website.
None of us has ever lived through anything like what we are experiencing with COVID-19. People are worried about their health and the health of their loved ones. They're asking, when can they get back to work? Or for those that have lost their jobs, when can they start looking for work? Everyone wants to know when we'll be able to get to the other side of this problem. I do too. Anytime there's uncertainty, and perhaps there's never been more than right now, people want forecasts. If you know me, you know I'm not in the forecasting business. If anything, this crisis should remind us all how bad people are at predicting the future. Who predicted 6 months ago that the world would look like this today? I doubt 1 out of the 8 billion people on this planet did. So while I don't have a crystal ball to see into the future and tell you when this will be over, I do have a lot of hope. That hope is based on what I'm seeing around the world. The energy and expertise of the human race is focused on this one problem. I've never seen anything like it. Governments are jumping in, trying to keep economies afloat. Even in the US, the legislative and executive branches have been working together. How many people a year ago would have predicted that a bipartisan bill worth $2 trillion would pass? Yet another example of why I don't forecast. The Federal Reserve is doing a great job. What we're seeing is so different from the Fed's response to the Great Depression. Back then, they did all the wrong things, like draining liquidity out of the system. They didn't know what was happening. Today, things are very different. What's the optimal amount of liquidity? We don't know exactly, but we've learned that it's better to overshoot than undershoot. Medical scientists are constantly developing new tools to fight this thing, from testing to treatments. They are studying antibodies and immune systems, and hopefully we'll soon have a vaccine in place. Great treatments are likely to happen even sooner. In the private sector, business owners are doing their darndest to keep people employed. No one likes laying off their workers. Businesses want to grow, not shrink. I'm so impressed with how resourceful and creative people have been in doing so much work from home. Watching all this happen within my firm has just been remarkable. There's been a lot of pain. There'll be more ahead. Lives are being lost. Many find themselves without jobs that were very secure just a month ago. But I believe things will get better. So I may not know the when, but I do know the who, why, and how. Human beings are wired to improve their lives and the lives of others. We're all pitching in and trying to help in every way we can. Washing our hands, checking on elderly neighbors, paying our dog walkers not to walk our dogs. It's the big things and the little things. There's so much spontaneous goodwill. This is what people do. We help each other. We fix problems that need fixing. That's the core of every great business. And that's why I have so much hope. While I may not know when we will right this ship, I've never felt more certain that we will.
So I hope that, I thought that was a really nice piece. I hope everybody enjoyed that. I thought David did a very nice job on it. So let's catch everybody up just on where we are right now. This is the S&P 500, and each time I've done a webinar over the last several months, hard to believe it was only in March, actually. Now here we are at the end of May. It's hard to believe it's only been a couple of months since really all hell broke loose. It feels like it's been years, doesn't it, everybody? But it's only been a few months. I mean, right? Here it is. Here's the fall off in the market, and as you see, the markets have continued to heal since really the last webinar a couple weeks ago. We've continued to see an increase in the market, and positive returns here in May. I think everybody knows that the markets fell off a cliff right here, and it was really the fastest decline in market history, but we have continued to see a healing there. As we look at bonds, what you can see here is 7 to 10 year bonds. This is an exchange traded fund, and you can see that, and this is Treasury bonds only, so this does not include corporate bonds. And you can see, let me get my drawing tool on again. Annotate. Let's see, draw. You can see that the Treasury bond was doing exactly the opposite of what stocks were doing. Everybody was fleeing to Treasury bonds, and the price was increasing. You can see up from this level up to this level. That's a very, very big move in Treasury bonds, and it's been level lately, right? We haven't seen a fall off. Bonds are still trading at approximately, Treasury bonds are trading at approximately the same place they were trading at. So what we've not seen is, while the stock market has come back, we haven't seen a fall off in the value of Treasury bonds, which I think is informative. It says people are still concerned. There's still lots of concern out there. If we were seeing a lack of concern in people and bond markets and Treasury bonds not being so sought after, we would have seen their price fall back. But that hasn't happened. We have this plateau here, and it suggests that maintaining a cautious stance in our outlooks. I know David Booth just said that he doesn't like to make forecasts, and I don't either. Those who know me know I'm not much in the forecasting business, but it is suggestive that caution continues to be something that we should all at least be able to make reference of, and not get exuberant about where markets are. This is the VIX. If you remember, this is the volatility index. And this is 5 years of the volatility index, and everybody can see on this chart that it absolutely goes through the roof right here, right? Just a straight up shot from a market that was quiet and not very volatile to, but look what's happened since then, right? We hit this peak, and almost immediately, as David Booth said, Federal Reserve actions, and not only Federal Reserve actions, but government actions, the CARES Act in specific, and the Payroll Protection Plan began to bring volatility in the markets back down. And it's continued to come back down over the last few weeks. This is a maximum reading on the VIX index. And here we are. This was the peak of volatility back in March, and the only comparable time period we've seen since the VIX was invented was back here in 2008, 2009. We did not quite hit the same peak. This was about a peak of about 80, right? That's kind of the highest reading we've seen on the VIX was back during the Great Financial Crisis. And usually you can see volatility is around the 20 mark, right? Somewhere around here. That's where the signal is. But boy, did we shoot up fast here, didn't we? But it has come down, steadily come down, and we've continued to see a reduction in volatility. And where are we right now? Well, about there, which is about 30. So we're not far in volatility terms from getting back to a normal, what we would consider a normal 20 reading on the VIX. And I'm sure everybody senses that, whether you watch the market or don't watch the market. I'm sure you sense that the finance and stocks and bonds are not so much in the news. And there's a good reason for that. I want to talk about a few items of note that have been going on over the last few weeks. European and Japanese actions. You may have seen that European nations, led by Germany, are now moving off, and Germany especially is moving off of its usual and traditional absolute resistance and reluctance to take any actions that would possibly even lead to inflationary effects. This, of course, has to do with the experience that Germany had in the 1920s with inflation really causing political problems in Germany that would eventually, not exclusively and not solely the reason why this happened, but would be one of the main contributors in the rise of the Nazi Party and Adolf Hitler. And in the wake of that experience, Germany has always been very reticent since World War II to make use of the money supply in very liberal, free spending ways. That has changed now with this virus. And over the last week, announcements were made that not only are they going to do it, but they're going to actually make grants. They're going to give money, literally give money to areas of the European economy and areas of the European household, shall we say, especially the southern countries, Italy, Spain, Portugal, Greece, that have more economic dislocation than the richer, more stable northern countries. So this is a first. And I think it bodes well for Europe. And that may seem strange, but really it's not much different than what's going on here in the United States with a payroll protection plan or tax rebates that are being made to Americans. It's a way of getting money during a crisis into the hands of those who need it. And the same thing is going on in Japan as well. The Federal Reserve actions have fully bolstered the corporate bond market in the United States. And has also provided support for municipal bonds as well. And so when David Booth says the Fed is doing a great job, that's what he means. He means that the Federal Reserve back in 1929 didn't provide the liquidity that was needed. Did in 2008 to 2009, but it caused an awful lot of political turmoil. In my view, a lot of that led directly to the rise of Donald Trump. The Fed took the actions that it needed when Ben Bernanke was leading the Federal Reserve, but it wasn't enough to stop the rise of Trump. And now, of course, while Trump is the president and Republicans hold hold the Senate and the crisis is on their hands, you don't hear much of a peep about Federal Reserve actions. So the CARES Act finally is a concern. It will be running out, and the support that the federal government is giving directly to households, and which has been crucial for those households, especially those households where job loss has been incurred. I think it's a 3 or 4 month period is going to run out, and Mitch McConnell today said that the next infusion of money into American households will be the last. We'll see about that. I don't know about that. I think the mood of the American people is that its government is going to do whatever it has to do to keep people afloat who've lost their jobs. I wouldn't be surprised to see Mitch McConnell have to eat his words. Now, whether he eats his words as the majority leader or someone who has been voted out of office come November, that I don't know. But I really don't know that this is going to be the last bailout, shall we say. And I really don't like that word, but really the last assistance that's given to American households. I think the American people, as I said, are in the mood to help those who need help and to use the treasury of the country to do so. We'll see. Well, let's talk about bonds. That's the purpose of the call tonight. Bonds have to everybody's surprise, gotten more expensive over the last couple of years. Most professionals coming into 2019, not this year, but last year, coming to January of last year, thought that 2019 would bring higher interest rates. And you may remember that we were seeing the 10-year Treasury bond pushing up toward 3%. Who can remember that, right? 3% on the 10-year Treasury bond. And that was really the prediction. And there were predictions that we would see by many professionals that we would see a 10-year Treasury bond north of 3%. why do we talk about the 10-year Treasury bond? I want everybody to understand that the 10-year Treasury bond, by and large in finance, is the reference bond. It is the bond by which all other bonds are compared. It's known as the risk-free bond. It's generally regarded to be the closest thing to risk-free. And you get arguments about whether it's the 30-year bond or the 5-year bond or the 2-year bond, but generally the 10-year bond in finance is regarded as the bond that doesn't carry risk. Now, of course, it has risk. It has interest rate risk. If you get a rise in interest rates, the 10-year bond will be affected by that. It has inflation risk. But it's generally accepted that the 10-year Treasury bond issued by the United States government does not have default risk, despite the fact that there were discussions, again by the Republican Party back in 2014 or so, that they were just going to let the US government default on its debt. It is generally accepted in the world that the United States will not ever default on its debt. Why would it default on its debt when it can simply print money to pay off its debt? And that's what all great powers have done. If you go back in time to the British Empire, Spanish Empire, and others, the ability to create fiat money is an incredible power, and it means that you won't end up defaulting on your debt. So that's why the 10-year Treasury is the benchmark and the reference bond. So all other bonds are measured according to their spread. What is their spread? What is the difference between the 10-year Treasury bond yield and the yield of other bonds? And most of the time, given the same duration, so a corporate bond that's a 10-year bond, or a municipal bond that's a 10-year bond, or some other bond, foreign bond, an international bond that's a 10-year bond, generally will sport a higher interest rate. Not in all cases. The German 10-year bond actually has a lower interest rate, and even we've seen negative interest rates in Germany and Japan. So the 10-year Treasury bond is now trading, and I'm going to break out of my presentation here and take you over to a site so I can show you that. If I still have it here, here it is. So what I'm showing you here, this is the current. So here's, let me use my drawing tool so you can see. So here's the 10-year right column, and I could show you the 1-month Treasury bond or the 2-year Treasury bond, right? Here's the 10-year Treasury bond, and this is going back to May 1st. So this is the month of May, and you can see that the 10-year Treasury bond at the beginning of the month was yielding 64 basis points, everybody. So that's very meaningfully under 1%. Now, if you're willing to buy a 20-year Treasury bond, it'll pay you a whopping 1.04%. And if you're willing to buy a 30-year bond, it will yield you a 1.27%. So think about that. If you were going to lend, and when I say buy a bond, when we talk about buying bonds, what we're talking about is being a lender. You're a lender, you're lending money. That's what buying a bond means. You're entering a bond where you are the lender and the borrower has the bond to pay you back your money with interest. So we have the 10-year Treasury bond. You could decide to lend to the federal government for 3 times that amount of time, but you're only going to get paid, as you see, 2 times the interest. That's where it was at the beginning of May. Now, where are we? Where are we now that we're later in the month? Well, things haven't changed very much. The 10-year bond is now yielding 65 basis points. 1 basis point up from the 64 that it was yielding at the beginning of the month. So that's what I was saying earlier. Even though things are, quote, calming down, the 10-year Treasury bond is still yielding 65 basis points. Now, how much of that is the Federal Reserve buying Treasury bonds? I can't tell you. Undoubtedly, it has a big role to play that the Fed is entering the Treasury markets and keeping bond yields down. If it didn't, we might see much higher yields. And you can see that during the course of the month, the highest point that we hit on the bond was what? Here, 73 basis points, something like that. I think that's the highest one. And the 30-year is still yielding 1.4%. So these are obviously incredibly low yields, and the risk to us to buy bonds on the long end of the curve is that we buy the bonds and then interest rates go up, and we will sustain losses on these bonds if yields go back to 3%. That's the big concern. So what is the solution? Well, the solution is we say we're not going to buy bonds that are that long dated. We're going to buy bonds that are, oh, I don't know, we'll buy 1 or 2 year bonds. Well, what does that mean the yield on the bond is going to be? Well, how does that look to you? 17 basis points, 16 basis points. This is for the Treasury bond. So what are people doing in reaction? They're buying bonds of corporations. They're buying bonds of municipalities. They might be buying bonds of emerging markets. They're saying, well, we're not going to lend to the US government. We're going to lend to other entities. But of course, those loans come with other risks. They're not risk-free. So this is the conundrum that we find ourselves in the bond market. And yet bonds have a role to play in protecting principal and protecting your capital. As we have just seen, when all hell breaks loose in the markets, and we've seen it over and over and repeatedly, it's nice to have a little bit of Treasury bond in your portfolio to cushion the impact of a rapidly falling stock market. So this talk is about, what am I going to do? Me, because it's my responsibility to give you a solution to that. All right, back to the presentation. Back to the slides. All right, here we go. To top it off, we've got we have an environment where businesses are struggling. Not all of them, but many are. Certainly airlines and restaurants and so on. And we have an environment where municipalities are having trouble with tax revenues and spending that they're having to do on COVID-related healthcare and other COVID-related actions. So we have some priorities. Number one, I am interested in avoiding undue credit risk. I'm not interested in taking a lot of credit risk that is undue. I will take some, but I don't want to chase higher yields so that you can make interest, but find out that there are defaults that are going on. We have a client who may or may not be on the call, but a client who entered a lending program. This is not something that I introduced him to. His son introduced him to it, and I think it's not a bad program. But this lending program was to provide loans to the residential housing market outside of the usual Fannie Mae and Freddie Mac channels. And the lenders make direct loans to particular borrowers, not to a basket of borrowers, but particular homes, particular projects. And so we checked in on this a couple of weeks ago to see how this program was going. And there are many delinquencies in those loans, many that are not paying. So I do not want to be in that situation with the bond portfolio. So I want to avoid undue credit risk, whether that's loans to companies or loans to mortgages or loans to municipalities. I want to be very careful in the credit risks that we take. I also want to avoid undue interest rate risk. We have very low interest rates right now, and bonds move inversely, you probably have heard this, the prices of bonds move inversely to their to interest rates. So let me just draw that here on this slide, right? So as interest rates go up, bond prices go down. So there's the bond and there's the interest. And vice versa. If interest rates go down, bond prices go up. And it's this, what we've seen happening since the 1980s. The trend has been that interest rates have fallen since the high rates of the late 1970s and 1980s, early 1980s. And as a result, bond prices have been in a 30-year, more really, 35, almost 40-year bull market. My concern is that this may be what we see going forward. It's possible now that we have hit really the bottom of interest rates. They could go lower, they could go negative, as they have in Germany and Japan, but there's not much lower to go, everybody, right? From 64 basis points, 0.5%, as I showed you just a second ago on the Treasury bond rates. There's not much lower to go. And it does seem like there's a lot higher to go. Now, I can't tell you interest rates are going to go higher. They may sit here for years and years and years. But it seems to me that the risk is that we may see higher interest rates at some point. And if we see higher interest rates, that means bond prices are going to fall. And that means the value of your bond portfolio is going to fall. So I am hesitant to take undue interest rate risk. I'm also hesitant to take undue inflation risk because high inflation can have a negative impact on bonds in the same way that interest rates do. So, how are we going to approach fixed income? Number one, I'm interested in increasing credit quality. And I've already done that, and I did that back in March by selling off a lot of bonds. And a lot of you have cash in your accounts now because I sold off bonds that were lower credit quality, so-called high-yield junk bonds. Many of them have stabilized since the Federal Reserve entered even those markets. But going forward, it's questionable to me whether we should be holding junk bonds and bonds of companies that may be extended, emerging market countries, and so on. So we've already seen an increase in the credit quality simply by selling those holdings. Reducing duration. And that means that we will gravitate more towards shorter term bonds than longer term bonds to try to avoid any damage to the fixed income portfolios that would result from higher interest rates. But that means that you're going to have to accept lower interest rate, lower coupons on your bonds. My hope is that you're going to not have high expectations in this area and that you're going to be willing to accept lower interest rates and lower coupon payments in return for having lower risk and lower exposure to interest rates rising or to credit deteriorating. And last is we're going to be increasing inflation protection in your bond portfolio. Inflation protected bonds issued by the Treasury of the United States became available in the late 1990s. This is a type of bond that is a Treasury bond. So the nice thing about it is that it doesn't have credit risk, just as regular Treasuries don't have credit risk. But these bonds have an additional feature, which is that they are guaranteed contractually to protect you from inflation. And there are many who think that, well, we're not going to see inflation. We've seen a drop in oil prices, although those oil prices, if everybody takes note, have now increased about 300% from when they went negative. That's a big increase. We have trade wars that are continuing to go on, and we've got disruptions in supply chains. And so it's not impossible that we would see an increase in inflation. Now, inflation-protected bonds will only protect us from unexpected inflation. Regular Treasury bonds already have expected inflation calculated into their prices and in their rates. So the inflation-protected bond will only protect us from unexpected inflation. But who's to say that we're not going to get unexpected inflation? After all, who expected a global pandemic? So these are the responses to avoid these risks: credit risk, interest rate risk, inflation risk. We're not going to avoid the risks. We're simply going to avoid undue amounts of them in the portfolios. And remember, you may have questions about this. We will be taking questions in a bit. This is how the categories of bonds are that I will be showing you in designing your fixed income portfolio: core bonds, short-term bonds, and inflation-protected bonds. This is how I want you to think about your fixed income portfolio. And for many of us, the fixed income portfolio is not at all insignificant. So for example, if you hold a 60% stock and a 40% bond portfolio, 40% of your portfolio is in bonds. If you have a 50-50 portfolio, fully half of your portfolio is in bonds. So it's important that we understand where we're going with bond portfolios. And I've spent now 2 months in meeting after meeting after meeting. And it's amazing because on a lot of the calls that I'm on, I'm the one who's pushing and asking questions of the fund managers and so on these calls. I'm not the only one by any means, but I've noticed that these questions have been a little more urgent to me than they are to other advisors. And whenever I've found that that's the case, it usually is meant that there's reason to be concerned there. Let's look at core bonds, the first category. I'm projecting, now these are not written in stone, but I'm projecting that that's going to make up about 1/3 of your bond portfolio. And look, you're going to get a whopping 1.5% at current yields. Core bonds will be composed of U.S. government bonds. You will have corporate bonds as well. Municipal bonds will be part of the core bond portfolio, but we're not going to overdose on municipal bonds. So those of you who have large taxable portfolios, in the past, I've gone with in some cases, almost exclusive allocation to municipal bonds. But I don't want to do that here. I don't know where the direction for U.S. municipalities is going to be. I think they're going to be fine, and I think the Federal Reserve will step in to bail them out. But I'm not willing to put 100% of your bond portfolio, even with the tax-free status of municipal bonds, I'm not willing to put 100% of your taxable bond portfolio into munis. They will be there, but they will share space with corporates and U.S. government bonds also. And finally, some international bonds as well. So this is core bonds. And what you can expect here is that the duration on the portfolio will be, let's say, about 5. So that's going to be the interest rate sensitivity of the bond portfolio. So what that means is that if interest rates go up 1%, if we see a 1% rise in interest rates, you can expect to see a 5% loss on your portfolio. That's what the duration of 5 means. So that may sound like a lot, but remember, the 10-year Treasury bond has a duration of 10. So a 1% rise in the interest rate environment means a 10% drop in the value of the 10-year Treasury bond. So I'm not even willing to take the same interest rate risk as in a 10-year Treasury bond. I'm shooting for 5. The next section of your portfolio, short-term bonds, and that includes cash, CDs, and money market. So that'll be included because these really are short-term bonds, right? Money market funds are a short-term mutual fund that is equivalent to cash. You'll hold U.S. government bonds in your short-term bond portfolio also. You'll hold corporate bonds in your short-term bond portfolio. So we will hold the short-term bonds of U.S. corporations and maybe some international corporations as well. And we will also hold shorter-term bonds and municipal bonds as well. And then inflation-protected bonds, the other 1/3 of the portfolio. So yeah, short-term bonds, about 1/3 of the portfolio, and inflation-protected bonds, again, yielding around 1.5%. We hold short-term inflation-protected bonds and long-term inflation-protected bonds. Whoops, sorry. And so those will be the two components. So you can see that this is a very substantial rise in the inflation protected portion of the portfolio. This is really where the most dramatic increase in new capital bond portfolios is taking place. 33% of the entire fixed income portfolio. Prior to that, I think maybe around 10%, right? So we're going from about a 10% allocation in inflation protection to 33%. And the goal there, is to make sure that your purchasing power to keep up with your expenses will be kept. I want to make sure that the purchasing power of your money doesn't get hit in the fixed income portfolio if we see an uptick in inflation. So that's the goal, to make sure that you're able to meet your expenses in the event that we get an uptick in inflation, unexpected and meaningful uptick. So this is the way portfolios will look. So you can see core bonds here, short-term bonds here, and inflation-protected bonds here. So let's say that you hold a 60-40 portfolio, which is very common. 13% of your holdings will be in core bonds. 10% plus, here's a 4% allocation to cash. You can think about it as more of a 14% allocation. And then a 13% allocation to short-term bonds. So I'll let everybody take a look at that and sort of find their allocation. Now, obviously, those of us who are on the more aggressive side in stocks, let's say you're 80-20, the whole bond portfolio here is only, plus cash, is only 7 and 9, right? And 16 and 4 for a total of 20, right? So obviously, the bond portion of the portfolio not nearly impacted by these changes as it is for here, much less here, right? Look at this portfolio. And we have clients who are 20, 80, and 30, 70. And frankly, they've looked very good this year. But in the case of a 20%, 80% portfolio, where 80% of the portfolio is in bonds, 27% in core bonds, 22% plus 4% in short term, and 27% in inflation protected bonds. All right, we're moving toward conclusion here. What are the risks? Well, we may have some underperformance versus indexes, right? During those times when really high risk bonds and high yielding bonds or longer term bonds are putting up bigger numbers, we would be expected to underperform. So everybody will have to understand during those periods that we are not trying to take risk in the bond portfolio. If you want to take more risk in your portfolio, I'd rather you do it by buying more stocks. I'd rather do it in the stock market. That's where I'd rather you take the risky part of your portfolio is in stocks. So it's a very, very important point. We may underperform longer term bonds or higher risk, lower credit bonds. I'm okay with that during these extraordinary times. I'd rather not take those risks. So if you feel like, I don't like the low yields on bonds, let's have a conversation. What I'd rather do is move you more into stocks. Okay? If we get deflation or depression even, inflation protected bonds are hurt during deflationary times because they do well during inflationary times. So the flip side of the coin is that those bonds don't do well during deflation or depression. That's why I'm keeping the core bond allocation in your portfolio, even though we're getting very little in the way of interest rates on nominal regular treasury bonds, just for this event and this eventuality that if that happened, you would have a portion in your bond portfolio that would do well during that period. And if we get rates that are flat for a long period of time, where we just sit here and sit here and sit here, well, then obviously you would have rather held the 30-year Treasury bond than the 2-year Treasury bond or the 5-year Treasury bond, right? Because it would have been paying a higher interest rate, and you wouldn't have sustained any damage to the portfolio from high rates going higher. They would have been flat. So that again is why the core bond position in the portfolio is there. So it's not without risk. As we try to eliminate risk, right? Certain risks, inflation risk or interest rate risk or credit risk, as we try to reduce those things, you are by definition going to potentially incur other risks. So we have to decide which risks we're willing to run. What I don't want is for you to run the risk that you don't get your money back because the borrowers go and default, or the risk that you aren't able to fight off inflation if all the money printing that's going on actually does result in higher inflation. That risk I don't want to run. Or the risk that we go from interest rates that are at 1% and everybody, sees interest rates rise as the economy strengthens and we come out of the virus, and we find a vaccine for the virus, and suddenly the economy's humming on all cylinders and interest rates rise steeply. That's not a risk that I really want to run, given the fact that we're at under 1% on interest rates. So these are the risks that I'm willing to run. I'm judging that these risks are better risks to take than the other risks that I showed you earlier in the presentation. Okay, so we'll stop there and take questions. I think I'm running pretty good on time. Am I? 6:50. So let me pause and we'll, Catherine, bring you back in and be happy to take questions now.
Yep. Okay, great. Thank you. And you can enter questions. Looks like one came in during the presentation. So feel free to, at the bottom of your screen, you should be able to see the Q&A menu. You can also type a question in chat. If you prefer that, we will answer questions from both of those sources. While those questions are coming in, I'm going to send a link now through the chat for the evaluation survey. If you would please complete the survey for us, any comments or ways we can improve, or any content requests, we certainly do read those and try to use those for future webinars. So we'd appreciate that. And so the first question that came in during the presentation is as follows. Here we go. With so much new money being pumped into the system from the Fed and Congress, what's to keep inflation, especially hyperinflation, in check?
Well, the thing that will keep inflation in check is that tends to keep inflation in check, but it doesn't have to, is low demand. And right now we've got 40 million people out of work. There's an article in today's New York Times, I believe, or maybe yesterday's, and it may be Neil Irwin, who says, don't worry about inflation. I ought to try to pull that article up. Don't worry about it. Well, I can't afford to not worry about inflation. It's been a long time since I've had to worry about inflation, since I was, 14 or 15 years old. But the thinking is that the economy's on its back, although I don't agree that it's on its back. But that there's such a lack of demand that companies cannot raise prices. And workers cannot raise prices or cannot demand higher wages because there's 40 million people. And if workers start demanding higher wages, companies are going to say, get lost. There's a huge labor pool that we can choose from. They may not have exactly the same skills, and we may have to do some training with them, but there are 40 million people out of work, and we're going to replace you. So that's the thing that would keep inflation down, and that's what the Fed has to watch, because one of the two mandates of the Fed is, remember, the Fed has two key main primary mandates. The first is to guard against inflation, manage inflation, and the second is to manage unemployment. So the Fed has a very big job right now, but that's theoretically what would hold down inflation. There's just not enough demand in the economy, and you've got a lot of people out of work, and people can't go out if there are 40 million people out of work and buy plane tickets and other things as well. Then you've got the supply issue too. You've got airlines, for example, that are desperate for business. So they can't raise prices. They're trying to get asses in seats right now, right? And so we have an asses in seats problem in the restaurant business, in the cinema business, in the travel business. Even if there was demand, the supply side is restricted because of the virus. So these are the arguments of why we're not going to see inflation, and that may be the case. But the actions that I'm taking in the portfolios right now are intended to be long-term actions. What I don't want to hear from clients is, wait a minute, you saw that the printing presses were going and money was being given literally out to companies and people and so on, and there were such things as inflation-protected bonds, and you didn't buy them? That I can't have. So there it is. Okay, next question.
That's it for now.
What?
No other questions for right this second. We can wait for a few more minutes and see if anything else comes in.
Let's do that. I do want to say thanks to Gary and Mary Ellen, who said, I think, didn't they say, way to go, Abby?
They said, great job, Abby, on the
great job, Abby. So
bridge picture.
So until I get another question, I will say I'm very, very proud. I'm very, very proud of my kids, and Abby's especially attenuated to injustice and has a very big heart. And we are trying our best to teach our children that injustices that occur in this country do not have to continue. It doesn't have to be. They have the power to make changes, and the place that starts is how they see other human beings in this country. And I'm very, very hopeful that that the country, and incidentally, this isn't just an issue relating to justice and the justice system. It relates also, I think, to the economy. Economy, after all, means household. It comes from the Greek word that means household. And we can't have a full economy, that is to say, a full household, if we have large segments of our population that are suffering from lack of capital and lack of care, lack of justice, and lack of access. So we have to solve those problems, because we can't fully, the economy will never be running on full cylinders. So when Donald Trump says the economy is running on full cylinders, it's the greatest economy we've ever seen, I say, really? Well, what about all the people in poverty? They're not running on full cylinders. Full cylinders mean everybody is able to be the best they can be. That's when our economy is running on full cylinders. And by the way, I do think that we are going. I'm very hopeful about the direction that we are taking. I think the pandemic has hit a lot of people upside the head and is causing them to think far more deeply about the issues. So I don't just like to say that what happened in Minneapolis the other day and what's happening in other places regarding issues of justice are separate from the economy. They're not. We're running at full tilt when children in those parts of our country are getting the educations they need, and people are getting job training, and the economy is growing to meet their needs as well. Then we'll be running at full tilt. Okay, editorial over. Any other questions, or should we let everybody go have their weekend? One
other question just came in. How has it been being back in how has being back in the office gone for you?
Thank you for the question. It's gone great. We, those of you who've been to the office, I think everybody has, know that we have tried to create a spacious and comfortable office environment for our clients and ourselves. We think that's important. to spend the day in a way that is comfortable and conducive to working for you. And I spend on that. And we've had, I think, 3 client meetings. We decided a few weeks ago that we would take meetings again with clients, and we've had 3 of them. We have moved, just so everybody knows, we have turned the conference table sideways so that I can sit on one side of the conference table and you can sit on the other side, and the conference table is exactly 6 or 7 feet or so. So we get that separation. We have hand sanitizer gel on the conference table and on the coffee service, and on the front we can offer you gloves and masks. I'm sure everybody's got their own, but if you don't or you forget them, we've got them. And so we are committed to offering a very safe experience to clients, and I've been pleased with how that's gone. So I've been happy to be back in the office. It's a weird time because, right, Catherine, some days we're in the office and some days we're at home, and we'll see how work changes. I think it's going to change, and we're going to have our own look at our own work policies and so on. But I think it's going well. I think work from home is going well, and we're proud to be part of. I think we're proud to be part of a movement of workers who are trying to find their way forward into the new world of work. So thank you very much for that question. I do appreciate that.
This is an interesting follow-up to that. It says, do you feel virtual client meetings are as productive as in-person meetings?
That's a great question. We had one client who was making a key decision of whether she works for an oil company, an oil and gas pipeline company, big one of the big ones, and they are offering voluntary severance. Meaning, if she takes the deal, they're going to give her 2 years of pay, and she wants to retire. She's in her late 50s, but she's tired of working and hasn't liked her job. And they wanted to come in. They felt that with a decision as big as and important as that, and we were going to do financial planning projections, that being in person was important to make sure that we didn't get any signals crossed. So what I would say is that there is no substitute for being in person. We can just do more, but I would say that the experience over the video is a decent substitute. I would say it's a decent substitute, not a poor substitute at all. It's not superior. It is superior in some ways. If you're in a hurry, if you want to meet now, we can meet with you quickly through the video. If you just can't get in, or we can't get you in, or we can't get in. So this is what I like. So I don't look at it as a substitute. I look at it as an alternative. And I think that one of the great things for us now is that the big problem before for us having video meetings was a lot of you as clients weren't familiar with the tool. You hadn't gotten on Zoom calls with your families. You hadn't celebrated a Passover Seder with your family in California, or an anniversary. You just didn't know which buttons to push, and you were frustrated by it. The good thing now is that it doesn't frustrate you, and so we can have these meetings. So I'm preferring not to look at video meetings as a substitute, but as an alternative. We're trying to see, how do we give people choices? And it may be that we say, you know what, we can do that meeting over video, and you'll get absolutely the same result you would get if we were in person. So I hope that answers the question. I like it. I'm excited about it. But really the main thing is that you all now are more comfortable with the tool, and we're more comfortable with the tool. Much as I fumble for where that annotation button is on my thing here during the webinars, which I'm sorry about. So I think it's all good. Nothing bad, all good. Anything else, Catherine?
Nothing else has come in. So I guess we can go ahead and close it out. If you have questions after the webinar, of course, you know how to reach us. email or phone calls. And thank you so much for joining us. Like I said, we'll do a recording of the webinar released on the Journal next week, and feel free to share that with anyone. And Leonard, I'll pass it over to you to close it out for the evening.
I just want to say I hope everybody has a great weekend and a great evening. It's a pleasure always, now that we've been doing these, to be with you. It really is. It's my pleasure, and I'm humbled when people show up for these webinars. You're doing a service for me. You're giving more than I am to you. I really feel that way. I feel like you're giving me a chance to clarify my thinking and prepare a presentation and put it in a format that is as clear as I can make it. And so the gratitude really is mine. And to you, Catherine, for putting it together as always. For you put the railroad car on the track. I have to kind of push the accelerator, but you get everything lined up like a railroad for me, and I appreciate that. So I'm feeling very full of gratitude tonight, and I'm going to go into the weekend with that feeling. And I wish everybody a wonderful evening and a fabulous weekend. And those of you who celebrate the Jewish Sabbath, we will tonight. I wish you, and even if you don't, I wish you a weekend Sabbath, a weekend of rest and peace to all of you out there. And thanks for being with us. We'll do this again, not next week, but a few weeks from now. And I hope you'll join us again then. Thanks very much.